Hi, and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week for our live weekly update of Next Week Today, where we cover everything from last week, what's been going on, and what we see coming up in the markets this week in the economy. Thanks for joining us. If you're listening to the replay on our YouTube channel or our podcast, as always, you can go to mikeonmoney.com to ask any of your questions, see any of our other content, and to reach out to us in any way. Keep in mind that everything that we cover on here is for information purposes. Always do your own due diligence, or reach out to us in person to get professional advice around your personal situation and how some of the strategies or the information we cover on here might apply to you and your portfolio selections. So with that, as always, we do a brief COVID update. Not a lot to talk about as far as changes. Obviously, there's some reopenings happening here in Canada. We're seeing a lot of changes in Europe, where we're seeing countries scrapping restrictions, or certainly scrapping testing as long as you're vaccinated. That's pretty much universal in most places, as long as you have proof of vaccination. They're lifting restrictions. We're seeing travel being lifted. UK, I think Denmark, Norway, I think Sweden's about to, and most of the EU countries looking to lift testing requirements to travel there, as long as you have proof of vaccination. BC starting back, opening up. Ontario, I believe, is today they're reopening, or started reopening. Quebec is also starting to reopen, as well as the other provinces. So things are moving along. The Omicron variant has, for the most part, everyone feels it's run its course. Obviously, a lot more infected during that period of time. There is a new Omicron variant, AB variant of the Omicron, supposed to be even more infectious, but it's another variation of the Omicron. So hopefully those who just got over it, including me, have at least some immunity to this slightly new variant. But again, pretty much the outlook now is, if you're vaccinated, things are going to reopen. Maybe not back to normal. I don't know that we ever expected the light switch to flip and everything to go back to 2019 type of life requirements. Still wearing masks indoors, large groups, and all these different other things. But hopefully, we're moving forward anyway again, and maybe 2022 won't be as limited as the last couple of years have. Of course, not going to go into a lot of detail with the current protests in Ottawa and across Canada. There's some pockets of protests around the trucking vaccination requirements for truck drivers going back and forth across the border to have proof of vaccine. That's just ongoing, and we'll cover it as it impacts on the economy. So with that, let's take a look at what we're watching for coming up. We're looking for the construction spending numbers out of December. We're looking for the PMI and the ISM, so the supply and the purchasing indexes for January. And right on time, GDP is going to be reported for Canada for the November numbers. I know a little bit behind, but that's just when we get them. We're also continuing with earnings season with Alphabet, of course, being the parent company of Google. Reporting ExxonMobil came out today, and General Motors, Starbucks, and UPS all reporting as well, coming up this week. So we had a good start on Monday for the markets, a nice rally. Kind of ending off January, which was pretty volatile. Today, still pretty green in the markets for my last look before starting this, but the stock futures turned a little bit red. Just packing on the corporate earnings. Have been some disappointments, especially in the tech sectors, as we've covered pretty much from last summer. The tech markets, more cost building in there, interest rate and inflation issues, supply chain issues, all added to their costs. So the earnings season's a little rough on them this year. And that's had an impact, a ripple effect across a few other sectors. And of course, we're still looking for the projected rise in interest rates that are looming over the markets as we head into February 1st today. So central bank is expected to raise that rate several times this year to fight off inflation. We'll talk a little bit what the numbers are looking like and what the language coming out of the central banks are. But they're looking to just slow the economy down a little bit. Again, it's all going to be about how much they raise the rates at this point. We talked a little bit about the Merck and Pfizer COVID pills. So this is the pill that is a new treatment for once you have COVID. So it's not a preventative treatment. It's for those at-risk patients where they can take the pills to bring down their symptoms, hopefully prevent hospitalization and reduce the stresses on the hospitals and the healthcare systems. We've seen Pfizer's getting approved and Merck's being approved, although Merck is starting to become the pill of last choice, especially in the US. Pretty much, and we talked about this when they first came out, the Merck's potential effects or their particular their efficiencies a bit less than the Pfizer's. So just Merck is kind of the last resort if you can't get the Pfizer or the Pfizer's not responding for you. But the Pfizer pill seems to have more effectiveness for those that have gone through the studies. Of course, inflation fears are still out there, and Biden, Biden's antitrust efforts, are having impacts on some of the M&A. And last year we talked a lot about, that M&A rush ahead of Biden's antitrust laws that they were putting into place. So there was a lot of mergers and acquisitions happening last year just to try to get ahead of facing some of the pushback of those antitrust laws. And now we're starting to see kind of the beginning of this. So, there's this plan out there by Cargill and Continental Grain to combine their two biggest chicken processing, Sanderson Farms and Wayne Farms. But those pretty much go up against a lot of the rules that Biden's administrations are pushing to put through. And we'll see if that impacts things. And also inflation. Sometimes these bigger and bigger conglomerates drive up pricing, which adds to inflation. So a lot of the M&A activities for 2022 are going to start to come under scrutiny of these new antitrust laws. So it's going to have an impact, and we'll have to keep a very close eye on. Other news we got out there: the Fed officials, say that the rate's going to come in March. We're pretty much on track for that. Now the language, though, they're cautiously signaling what might follow that, but they're basically saying they may not come, to have to do too many or too much. The language is softened a little bit on how many and how high the rate hikes are going to be. So that's favorable. Probably why we're seeing more green in the markets these days. Just thinking that the rate hikes might not come too fast and too furious this year. So good news or good language coming out of the Feds. Oil forwards, certainly signaling a tight energy market. This has been a theme since again last year. Those supplies aren't there. We're going to talk about a little bit about Exxon's earnings and what's going on there in the oil and gas market, but obviously we're still seeing continued demand, soaring prices. We broke through 91 last week as far as the oil price goes, and still seeing a supply constraint on that front. Inflation, as I mentioned, the Fed data is looking at inflation is expected to actually stabilize after one or two hikes. So just leads to that expectation for this year that it might not be as bad as expected, which would be great if they could raise rates nice and slowly, nice and steadily, let the economy absorb those rates without having too big of pullbacks. Obviously, there will be effects on the markets when those hikes happen, or as we get the expectations of those rate rates happening, but hopefully not too big of hikes or unexpected hikes along the way. U.S. public pension funds are turning a bit more aggressive on their investments. As pension funds, have to keep up with deposits and keep up with the demand or the cost of running them. They're turning more and more to the equity markets for higher returns. Obviously, that means they have to deposit less capital into those pension funds. But when we say more aggressive in the pension funds, that just means more equities. Doesn't mean it's taken a very speculative approach. But that bodes well again for the equity markets as we see more cash or more capital flowing into equities versus say bonds or real estate or real assets. And also in this case, it's good for portfolios. As we've talked about, the growth market versus the value market. So those value companies, tend to be high cash flow or high growth in cash flow. This is where the pension funds are likely going to look for the returns. They're not necessarily going to be chasing the high torque type of investments or growth out of the market. And there's been a lot of value in that side. So not a lot of surprise. We've seen more pension funds move into that arena. Analysts are eyeing UPS's automation efforts to offset their increased wage costs. So as mentioned, UPS reporting this month. Labor costs, of course, going up through all this. There's a labor shortage. Companies are having to pay more in order to get more employees, and of course the shipping during the holiday season, the fourth quarter of the year for UPS. They had to pay up to get those staff and get people out on the road delivering items. But they're also turning to automation to offset some of those costs. So, there's this tipping point that we really looked into this early on when, the whole argument around the $15 minimum wage kind of argument came out. And should they, shouldn't they? Obviously the cost of living certainly warrants a $15 minimum wage, but there is a tipping point for companies that, at some point when the wages get so high, it's worth investing in automation. And the best example I can give that you might see day to day is if you go to any of the fast food chains these days, especially places like McDonald's and the such, you'll go in and you'll see order terminals, meaning people don't have to interact with individuals. You can just place your order. And there's even some locations that's the only way you can place your order. There's still people working preparing the food, but the front staff has been replaced by automation because it became the tipping point of paying a higher wage for someone to stand at that front cash, taking the order versus implementing the technology to take the orders, electronically. So this is the same thing we're seeing with UPS and other industries. Is as wage costs go up, it does mean job replacement for automation. Now that doesn't mean jobs go away. It just means it's tends to create new jobs. If you think back to the late 80s, early 90s, when technology started, we came out with the ATMs, your automated tellers at the banks. Tellers thought we're going to lose our job because the banks are just going to put in the ATMs. And that's true. A lot of business went to ATMs. I personally generally do mostly electronic banking. I don't go into the bank branches very often for any services unless there's something specific that I need. But we didn't get rid of tellers. In fact, there's more tellers been hired at the banks. They just do different functions now because certain repetitive functionality was taken away from them and others were added. So that's really what we're going to see here is in a lot of industries, and UPS being one of them, where some functions are going to be moved to automation, but new roles, new jobs, maybe even higher paying roles because they might have more responsibilities, will be added to replace those jobs. Let's take a look at what we're seeing coming up next week. Coming up, as I mentioned, Google reporting should be a pretty good revenue quarter for them. The cloud business, of course, has been booming. This has been the shift of through the pandemic for not just the remote work, but businesses shifting to cloud-based versus internal service bases. to service those remote workers, but they're also shifting a lot of their other operations to the cloud. So that's been really good for Google, parent company Alphabet, and also, you know, the online advertising numbers have been really strong across the board. As I mentioned, we're looking for the Purchasing Managers Index and as well as Supply Management Indexes. Likely a little bit of a drop from December numbers, coming off highs, coming off you know, the ramp up into fourth quarter last year with the supply chain issues. You know, a lot of people jumped ahead of the game in December, ramping things up. And as we kind of normalize a little bit in 22, I don't, you know, not really dropping, but just normalizing. We're just coming off those highest numbers. And that goes as well for the job openings and labor turnover, the JOLTS numbers. We're, you know, likely to see openings fall to about 10 million or 10.3 million from 10.5, 10.56 million in November. Again, that was just, you know, that surge going into the holiday season. And the construction spending data is due. It's expected to increase. We haven't really seen too much of a slowdown as far as construction and renovation. And if you look around your neighborhoods, you know, I'm sure you've noticed that as well. ExxonMobil is scheduled to report, or actually did report today. Chevron reported its fourth quarter missed estimates due to weak outlook of its oil and gas production. So that's Chevron, like some of the larger companies, you know, having closed some production during the pandemic and shifting some of their reopening efforts to alternative areas of energy. So, you know, Chevron missed a little bit on the profit side. Exxon, on the other hand, if you remember back in 2020, Exxon had the biggest write-off of their earnings in history, taking down some goodwill numbers. And usually what happens, you know, and of course in 2020, during the midst of the shutdown or the early shutdown, oil companies, oil prices sank completely, actually went to negative $34 a barrel for one day of trading. And oil companies obviously got hit really hard during 2020. And what some companies do during those periods is they take advantage of it. They know it's going to be bad news. They know the stock's going to take a hit. So they take advantage of that and they write off everything that's kind of been looming on their balance sheet. They just take the opportunity and say, okay, we're given such bad news, we might as well pile on all the bad news at once. Exxon did that back in 2020. So actually their earnings number, I haven't gone through them in full detail yet, that just came out, was a record quarter for them. So a great day for Exxon. The stock's up over four bucks a share, which is great to see. And that's the same, you know, if you've been in the energy ETFs, they're going to reflect those numbers overall from that energy crunch. So a good quarter for Exxon's outlook and numbers. Other top news in the U.S., Exxon also put out sweeping restructuring and cost cutting. This is combining, or they're taking the refinery and their chemical business and combining it, and really creating that alternative energy platform, which they announced that they're shifting to, and just putting that on the same footing or the same importance as their other divisions, and that's to grow it moving forward. Spotify shares rebounds a little bit after pulling back, still down for the month. And if you followed a little bit of this story of the Joe Rogan podcast versus Neil Young's pulling his music from there. So if you listen to a podcast at all, you probably heard of Joe Rogan. For some reason, he gets more downloads than we do on the podcast, but he's the #1 podcast, you know, as far as download numbers go in the world. He's exclusive on Spotify. Spotify reportedly or rumoredly paid $100 million to have him move to Spotify and be exclusive there. So he's a big name. There's a lot of investment for Spotify, but some musicians pushed back because he also has had guests, and I don't listen to it, so I won't comment exactly what was said on his podcast, but the general theme of it is a little anti-vax, or at least misinformation around the vaccinations. So Spotify shares took a bit of a hit. some musicians started, piling on, saying we're going to remove our music unless you do something. So Spotify came out and said, okay, here's our rules, and we're going to slap on a disclaimer to not just Joe Rogan's, any podcast or any of their content that may be controversial or may not be, exact. And they're also publishing those rules so that people know what the rules are and if someone's breaking the rules. So that kind of happening, bit of maybe a band-aid solution. Joe Rogan also kind of came out to pledge he's going to be more balanced, and I didn't listen to it, but the summations where he's going to try to be a bit more balanced and be a little bit less one side or the other when it comes to that particular issue or any issue, hopefully, when you're dealing with facts that affect people. So if you're investing in Spotify, hopefully we'll see continued recovery on the stock share price, but it did take a bigger hit and it has not fully recovered. Elliott and Vista Equity, so two private equity firms, are out there building out their clouds. We talked about Alphabet having a good quarter, or supposedly going to have a good quarter due to the cloud business growing. So Elliott and Vista is out to buy Citrix Systems, which is a technology firm focusing on cloud business. They're paying $6.5 billion to take that private, off the market, and probably will try to grow and consolidate that and roll it back out at some point in the future. And if you followed our last week video, we talked about Microsoft out there buying Activision video games for almost $70 billion, just shy of $70 billion. And Sony, of course, a big competitor. Well, Sony larger than Microsoft when it comes to the video game side of things. Obviously see Microsoft now as a bigger competitor, as they've done several acquisitions over the last year in the video game space to become number 3 in the world, just behind Sony and Tencent out of China. Sony went out and bought the Halo video game creator Bungie for a much smaller number, $3.6 billion. So obviously Bungie being a smaller firm. Halo, if you follow video games, the big names there are the Destiny names, which is a spin-off of Halo. Although Halo, the game itself, if I understand this correctly, and do not quote me on this, is not actually made by Bungie anymore. It's owned by someone else. It was originated by Bungie, and the early versions of Halo, Halo 2, and Destiny, which is, as I mentioned, a spin-off of Halo, is still owned and operated by Bungie. But the actual Halo brand has moved on. So Sony may not actually own the Halo title, but they are building out to try to keep up competition with Microsoft. Facebook owner Meta is lifting a bit of the veil on what this metaverse business is for them, and they've come out where you can digitally create your virtual reality avatar, and they're going to roll out here shortly. You can teleport to places like Rome with your avatar, and I guess do a tour. I haven't been. My son actually, he doesn't have the Facebook Oculus, which is their virtual reality. I call it headset. I'm not sure what the actual term is. He has another version, but same idea, I suppose. So I've not kind of gone into the Facebook and take the Facebook metaverse and take a look at this, but they're just rolling out their new upgrades to this metaverse and giving a little bit more, I guess, substance to what the metaverse is going to be look like from an investment standpoint. Because this is not just about Facebook. Facebook, of course, is the parent company is renamed to Meta around the metaverse, but the metaverse is actually larger. Amazon's starting to come out with metaverse announcements where supposedly you're going to be able to go shopping, push a cart around a grocery store and virtually pick up items and put them in your shopping cart and order it. I don't know how that's better than just going on to the Amazon webpage and buying them, but maybe I'm too old to appreciate this stuff. But you've got the likes of Nike and other major brands, almost any major brand out there building for this metaverse where you supposedly, again, I've not fully experienced this, but go in, look at the product, be able, 3D, examine, interact, ask questions, and decide, whether you want to buy it, not buy it, whether you like it or not. Early stages, I would say, but I'm going to have some more information on the metaverse because it is growing rapidly, and you want to know kind of what areas to focus on if you want to invest in that, and what areas not to. If you are really interested in the metaverse, there is a metaverse ETF, Evolve ETFs, because you may know if you follow me, I really like Evolve. They tend to be kind of innovative and on the cutting edge of especially disruptive technologies. They've launched a metaverse ETF. If nothing else, go take a look at the companies that they're putting in there, and you can kind of see where the metaverse is growing as far as investment opportunities go. I'll probably interview Raj, the CEO of Evolve, just to get more insight into how they built their ETF and the different areas of the metaverse that you can invest into, just to give you a bit more insight. And in fact, go to mikeonmoney.com, fire me an email if that's something you're interested in. I can definitely reach out to Raj and get more details for you around what they're doing in their particular ETF and other opportunities in that part of the market. On the US dollar front, we did see it pull back a little bit. It was holding in and climbing last week, mostly again on that rate hike, kind of protecting the dollar. Saw it pull back a little bit against the basket of international currencies, but not a really concern that that policy is going to tighten, and we should see it hold in there. Probably pulled back a little bit on the language softening just on how much they're going to raise this week, which is good, or this year, sorry. But that's good news. We're also seeing the European Central Bank becoming a bit more hawkish about signaling tightening theirs as well. Thursday's meeting is going to be about supporting the euro. This recovery, though, might not last. Probably a little bit more weakness in the euro. For the major currencies, it's not one that I would run to as far as investment goes this year. I think it's going to lag a little bit, as I mentioned before, and we've already seen a big movement in the pound. I think that one's probably a good one. And of course, as always, if you're looking for international currency safety, the US dollar always is predominant there. The treasury yields, little bit of movement, but pretty flat from last week, as not much has changed on the outlook there. Commodity prices, as I mentioned, oil doing really well, broke through 91 last week, pulled back a little bit. I think it's somewhere around 89 this morning, but the outlook is still strong. As far as demand goes, we're still seeing concerns around the supply. We have the tensions, I guess is a calm word to use, around the Ukraine situation with Russia and the NATO allies, all putting pressure on the oil markets, and that is expected to kind of continue. So with that, as always, send in your questions. Send in any topics you want us to cover. Let me know on the metaverse idea if you want to hear Raj about the new ETF that they've launched. It's been down out of the gate, if you're looking at it, not surprisingly, just because the NASDAQ and technology in general has pulled back over the fourth quarter and into January. But if you're looking for a diverse approach or a diverse investment in the metaverse, take a look at it. If you're just interested in metaverse in particular, take a look at its holdings. And again, if you have any particular desire for us to interview Raj and get more detail, let me know at mikeonmoney.com. As always, you can find all our other podcasts and videos and content on there. And we look forward to talking to you next week. But enjoy this week. If you're in Vancouver, looks like we might have a little bit of sunny. If you're back east and you're in a snowstorm, or you're expecting a snowstorm, my best, and stay safe out there for another week. Thanks, everyone. Take care.